welcome to another brand new video. Today we're talking about bonds and inflation and why I think bonds are a scam. First of all, what are bonds, right? Bonds are debt securities, in other words, financial instruments backed by debt, um, issued by governments to borrow money from investors with the promise to pay back what the investor has given to the government plus a periodic interest. Okay. So, for example, let's say, let's take the US government bonds. You can see there are different types of bond. Bond that matures in 1 year, 2 years, 5 years, 10 years, 20 years, 30 years, and all other measures in between. But these are the most common, most common. So, for example, if you buy the US government bond with 1 year maturity, the let's say you invest 100, the government is gonna pay you 104 after 1 year. Or similarly, if you invest in the 2 year, you put 100, they're gonna give you 3.9 after 1 year, and on the second year they're gonna give you 103.9. You get it? Or you invest in the 5 years, you put 100, every year they give you 4, and then on the fifth year they give you 104, right? And so on and so forth. And as you can see, as it should be, the longer you go out in time, the higher the yield, because there's a higher uncertainty, right? Like just like very intuitively, if you have to borrow money to somebody, and this person tells you, "I'm gonna give you the money back the next year," okay, you're okay. Maybe I'm just gonna leave the interest rate at 4%. But if this person tells you, I'm gonna give it back to you in 30 years, well, then you're like, okay, I need a higher yield to convince me because there's higher uncertainty, um, higher risk. So the longer you go out in time, the higher the yield. Now, going back to our presentation, so this is sort of considered a safe haven, a safe investment, a certain return, because governments, differently than individuals, can print their own money, and so they will always be able to pay you back. Well, it turns out that's not true because sometimes government default. The Greek government did it, other governments did it, but let's just pretend they can pay you back anyway, anytime, which is mostly true for most of the time. Um, Going back to our presentation, so we understood what bonds are. Now, so my thesis is you should only invest in bonds if the yield, right, the interest that they give you, also called the yield, it's significantly higher than the inflation rate. Otherwise, we are not going anywhere. So let's make the case for Italy, for example. Italy has had over the last 50 years, Italy had a 5 point, let's call it 5.9% inflation rate. And other countries as well, you can see, had a similar inflation rate for different periods. Now, the point is, I think it's a scam. So first of all, these were let's consider only Italy, and the inflation numbers we had are considering all institutional sources, which probably lie because they have other interests than yours. They don't have your money in their best interest, right? Their interest is to keep the power, so to keep the ability to borrow money. So but anyway, let's pretend that they always tell the truth, okay? So Okay, let's say you lose 5.87% of purchasing power every year. Uh, but you invest in bonds. Well, if you invest in bonds, the yield of the bond is not enough to make you earn more than what inflation is eroding you, right? That's my point. My point is a scam. It's very simple, actually. You can see it yourself for where was it? For example, the U.S. yield. Okay, currently, as we speak, inflation is around a little less than 3%, but they are giving you 4%. So, what are you earning? 1% a year? That's ridiculous. Even even sup- Even assuming that inflation is 2%, which is not, and they give you 4%, you're just making 2% a year. So that's not enough, right? And by the way, somebody could say, okay, well, then let's just invest in the stock market, um, which let's take the same period in account, the last 50 years. Over the last 50 years, the average gain of the stock market was 10.7%. Okay. So if you invest in the stock market, you gain 10.7% on average every year, which is more than bonds. But, but your inflation is 5.9% a year. Mm, so to calculate what you actually get, you could say, well, then you're getting 4.8% gain. But no, because you have to take out capital gains, right? So in Italy, for example, capital gains are 26%. Uh, of your gains, in this case 10%. So at the end of the day, you are getting 2% a year. Okay. Not even accounting for commissions, management fees, so on and so forth. Now, um, so the non-player character, average boomer, average PhD in economics, who only follows the mainstream path and doesn't think critically, says, well, but bonds yield follows inflation, right? I'm gonna take a step back. So this bond yield that you see, let me check it out. This bond that you see, this yield that you see, is actually changing. You can see, right? Like it's constantly changing over time. Let's take it on the weekly. It's constantly changing over time, and it should change according to the inflation rate. Actually, it doesn't. It changes accordingly to the central bank interest rate. Okay. Um, but it's dynamic. So the NPC boomer will tell you, well, but it changes according to inflation, right? You had zero inflation here. That's why the yield was zero. Now you have 3% inflation. That's why the yield is 4. So it's good. Or, for example, here going back all the way to the 80s, inflation was super high, and so the yield was super high. So, in a way, this is true. In a way, it is true that the yields are dynamic and um, and they do change with inflation a little bit. Um, but still, it's not enough to me. I'm gonna explain you why. First of all, it's not fast enough, okay? Because, like, for example, in 2022, in Italy, there was an inflation rate of 11%. 11, double-digit inflation. Where, but still, the bond yield was not 11%. It was somewhere down in the 5%, 4%. Don't remember exactly, but far, far, far behind the inflation rate. Plus, the inflation rate, it's it's changing fast, and it's not fully controlled by the government. but it's controlled by the prices of things, the money supply, yes, which is controlled by the government, but it's also mainly driven by energy prices, right? So if oil and gas, oil specifically, if the price of oil goes up, then inflation goes up super fast. Like in your life, practically speaking, if tomorrow there is a war, which may be, the price of oil will skyrocket um, by many percentages, maybe double digit percentages. It could even double, right? We saw that. Mm, but the yields are not fast enough. They never catch up with the actual increase or decrease um, of the cost of life, of inflation, of real inflation. So it's not accurate, right? Yeah, it's not accurate. So you're getting left behind. And this is the end result. Check it out for yourself. So this is US, but I'm sure we can extend this data to basically the whole world. Um, this is the this is a graph comparing the 1% earners in the US versus the middle class and their wealth, their aggregated wealth as a percentage of the total wealth. So you can see that the top 1% are always going up, whereas the middle class is always going down. And this, why is this? It's because people in the middle class, they sort of get obliged to invest in these kind of things, in bonds. And so their purchasing power just gets eroded every day, every year, constantly. Whereas the top 1%, not only they are gaining more because of their business, because of their salary, because of their business activities, but they gain more because they can take the risks to invest in actual things that increase in value. Bitcoin, Tesla, Amazon, whatever, what have you. It doesn't matter. Rich people are smart enough or can risk enough to go out in the risk curve and actually invest in things that yield real returns. And eventually they get richer and richer and richer. Vice versa, the middle class deposit their money in the bank or just simply follow their financial advisor uh, instructions, which they basically say invest in bonds, and their purchasing power gets eroded. And this is what happens at the end of the day. You can see that uh, this is thanks to Bravo's research. This is the delinquency rate of multifamily housing in the US, and it's going up. Why is it going up? Well, because the middle class, which is people owning multifamily housing, right? Because if you're rich, you don't own a multifamily house. You just own a huge villa, maybe, yeah, maybe a couple condos here and there, but you don't live in a multifamily house. You don't have a mortgage on a multifamily house. Uh, so you can see delinquency, which means people that are not paying, it's going up. Meaning people are distressed financially, people are getting poorer and poorer, and this is also the result of the scam of bonds. Okay, I argue. So going back to the market, you could invest in something that yields you 4% roughly a year and hope inflation does not get higher than this. And the minute inflation gets higher than this, first of all, you're losing money, but you're stuck. You cannot get your whole money back because now you have a, it's like it's, in Italian it's obbligazione. You have a, you have a bond, right? You have an actual bond with the government. You have a contract with the government. You have an obligation to the government. to lend that money to the government. You cannot just say, hey, inflation went up, I want my money back. That's not how it works. The yield may change, but it may, and it's not going to change fast enough and accurately enough to satisfy um, the appreciation to, but it's not gonna change fast enough to stay behind. So you could, so going back to the markets, you could like invest in something like this that gives you like 4% a year roughly. But the problem is, if when inflation goes high, it's not if, it's when inflation goes high, you cannot just say, okay, I want my money back, I want to put it in something else, because the yield that you are giving me, it's not high enough to balance the inflation, right? It may be close to it, but it's not enough, right? Like it's not fast enough, it's not accurate enough. So you want your money back. You cannot, because now you have a bond, right? You have a bond. You have a contract, an obligation. You have an obligation to lend your money to the government. And if you want your money back, now you have to sell it at a discount, right? Somebody else, you can sell the bond, you can sell the contract to somebody else who is gonna buy that bond, but that's gonna come at a discount. So you're losing, right? You know what I mean? Or you can say, I'm gonna invest in something like this. And I mean, let's check out what is the yield of Bitcoin. Let's say you invested 100 in Bitcoin in the last 5 years. What is the yield? What is the average yearly gain of Bitcoin over the last 5 years? Well, you can see the average gain, it's 100%. Or if you take it the compound annual growth rate, it's almost 60%, right? But basically, it's 100%, right? So you're doubling your money every year with Bitcoin, right? So this versus this, right? 4% a year. Now you tell me what's the best option, right? So this is what I'm talking about. I'm talking about you think inflation is going to be 3%. The government thinks inflation is 3%. So you put your money in bonds and you get 3%, but actually inflation is it's 5, 6, 7. Oh, you don't know. You don't know. Inflation is always going higher and higher. So this is the meme. This is the meme of the day. So when you invest your money in government, you're basically hoping inflation doesn't go too high too fast. But this is what inflation is doing, right? Like it's going higher and higher and higher and higher and higher and higher. So you know what the solution is. The solution is to buy Bitcoin, or at least invest in something else. But the problem with something else, which is probably a company, uh, is that there is risk associated with it, right? So you have bonds, which are the less risky theoretically thing, and then everything in between, all the way to very, very risky startups. The problem is, even these that shouldn't be risky, it's making you losing money. So opt out with Bitcoin. Now, there are other implication of buying bonds, and that is that you are effectively lending money to the government. And you may say, well, that's good. I'm helping my government. I like to help my government. Let's help my government. I'm not that sure, you know? I'm not that sure because let's just take a quick look at it. Let's ask Grok. Hey Grok, um, how much money did the USA, let's say you are in the USA, right? And you buy, or you're not in the USA. you are in Italy, but you buy US bonds because currently US bonds yield more than Italian bonds. So you're always going to be buying the bond that yields the most, not the bond that yields less, right? Because you want to make more money. So you're going to invest in the USA bonds. You're not going to invest in the Argentinian bond because maybe they're not going to give you the money back. You're not going to invest in the Greek bonds because maybe they're not going to give you the money back at all. So you invest in something safe, but still with a high yield, high enough to actually uh, make you earn some bucks, right? So let's say, how much money did the USA spend on war in 2025 only? So why I'm asking this? Um, because I don't want to give my money to war, for example, right? I don't want to, I don't want to stay afloat with inflation by lending money to a war machine. As you can see, the US Department of Defense budget is approximately 850 billions. So you're basically giving money to war. And the same is for any other country. And you might say, well, but I'm also giving money to healthcare, to education, so on and so forth. Well, that's maybe a good point. That's maybe a good point from you. But I don't agree. I don't want to lend my money to the government. So to me, there are two types of scam. I- So to me, it's a double-edged. It's like a two-way scam. They're scamming you in two ways. First of all, the yield is too low. What is 4% yield? 4% yield when inflation is 3% is just barely staying afloat. Okay. And by the way, let's check out, you know, like let's check out in 2022 when inflation was in double digit. Here inflation was in double digit and you were getting 3%. Inflation was 10% and you were getting 3%. So this is scam number one. And scam number two, they are using the money to fund the wars, right? So this is the solution to me. Bitcoin is the solution because endless war are only possible because there is endless money printing. Fiat currencies are infinite exactly because with this bonds mechanism they keep printing, they keep borrowing, which is another way to print, right? They keep borrowing and borrowing and borrowing and borrowing. So they keep funding and funding and funding the wars. So what we Bitcoiners want, and maybe we live in a utopian dream, but we want to be the change, right? We want to stop this unstoppable war, uh, permanent war. We want to stop the permanent wars. And Bitcoin makes war unaffordable because instead of giving your money to the government, you're sucking out liquidity, fiat currency, into another system, a parallel system that cannot be inflated away, cannot be printed, and hence brings to peace, hopefully. It's going to be a long process, but I'm not the only one, uh, which says peace begins when the printing ends. Defund the war machine, defund the oil warmongering military industrial complex, opt out with Bitcoin, do the right thing, buy Bitcoin. See you in the next.